Meaning of public finance, its components, objectives and functions. What is public finance? Definition. Public finance implies a branch of economics which is concerned with government activities and the various sources of financing expenditure. Basically, it deals with government revenue, expenses and debt, as well as its impact on the entire economy. As its name suggests, public finance is all about management of finances of the public authorities or public bodies such as central government, state government and local self-government for carrying out their operations, which result in incurring money for providing subsidies, public utility services and welfare payments to the residents. Public utility services include education, health, sanitation, transportation, infrastructure, electricity, communication, food, etc. The basic source of revenue to provide the services are taxes, duties, fees, foreign aid, sale of goods and services, borrowing, creation of new money, etc. Public finance is the management of a country's revenue, expenditure and debt loads through various government and quasi-government institutions. Public finance is the study of government activities which may include spending, deficits and taxation. The goal of public finance is to recognize when, how and why the government should intervene in the current economy and also understand the possible outcomes of making changes in the market. Also, public finance can involve issues outside of the economy including accounting, law, public finance management. Understanding the role of government and how these changes may impact the economy are a few important aspects of public finance. When the government intervenes and takes action within the economy, the outcomes are classified into one of three categories: economic efficiency, distribution of income or macroeconomic stabilization. Public finance studies how the government raises funds, where it spends the funds raised, how the government operating at different various levels provides necessary services and facilities to the public, and how the government arranges funds to provide these services. In finer terms, public finance look after the facts, principles, policies, theories, techniques, rules and problems which determine, direct, influence and regulate the use of financial resources to alternative projects initiated by the government. Components or elements of public finance. The main components of public finance includes activities related to collecting revenue, making expenditures to support society, and implementing a financing strategy such as issuing government debt. The main components include public revenue. Public revenue is also called as government revenue. It covers revenue generated or received by the government from various sources: tax revenue and non-tax revenue. Tax revenue covers income from income tax, corporate tax, taxes levied on imports and exports, excise duty, goods and services tax, etc. On the other hand, non-tax revenue include income from fees, surplus of public sector undertakings, capital receipts, fines and penalties, grants and gifts, central bank revenue, etc. Tax collection. Tax collection is the major revenue source for governments. Examples of taxes collected by governments include GST, income tax, a type of progressive tax, estate tax and property tax. Other types of revenue in this category include duties and tariffs on imports and revenue from any type of public services that are not free. Budget. The budget is a plan what the government intends to have as expenditures in a fiscal year. It is the estimation of revenue and expenses over a specified period of time, generally future. It is re-evaluated on a periodic basis. Public expenditure, as the name itself signifies, public expenditure refers to the expenses incurred by the public bodies in order to fulfill the overall needs of the general public, or it refers to the estimated spends of the government during a given fiscal year arising out of the certain government schemes or public policies. The expenses are made in connection to the investment in defense activities, healthcare and medical research, economic development, infrastructure development, provision of social security and maintenance of the government. It has broadly two classifications: revenue and capital expenditure. For example, construction of highways, hospital, etc. are part of government expenditures. Economists have classified the government expenditure into three main types. Number one is government purchases of goods and services for current use are classed as government consumption. Government purchases of goods and services intended to create future benefits such as infrastructure investment or research spending is government investment. Government expenditures that are not purchases of goods and services and instead they represent transfer of money such as social security payments are known as transfer payments. Deficit or surplus. If the government spends more than it collects in revenue, there is a deficit in that year. If the government has less expenditure than it collects in taxes, there is a surplus. Public debt, also referred to as government debt, it indicates the total outstanding liabilities amount which a country owes to creditors, which can be individuals, undertakings and other governments. The creditors can be internal debt borrowed from domestic lenders such as banks or financial institutions, and external debt borrowed from international financial institutions and governments. It is the accumulation of the government's annual budget deficits. It is also known as government debt. It is caused due to deficit spending by the government. Next point is financial administration. Financial administration is that portion of public finance which focuses on the demonstrative control techniques and issues concerning the preparation of the budget. It is a tool through which financial operations of the countries are performed. Objectives of public finance or functions of public finance. There are three main functions of public finance as follows: allocation of resources, equitable distribution of wealth, economic stabilization, aids in provision of employment opportunities. Number one is allocation function. There are mainly two types of goods in an economy: private goods and public goods. Private goods associate exclusivity to themselves. Only those who pay for these goods can get the benefit of such goods. For example, a car. On the other hand, public goods are non-exclusive. Everyone, regardless of paying or not, can enjoy benefits from public goods. For example, a road. This function deals with the allocation of such public goods. The government has to perform various functions such as maintaining law and order, defense against foreign attacks, providing healthcare and education, building infrastructure, etc. The performance of these functions require large-scale expenditure, and it is important to allocate the expenditure efficiently. This allocation function studies how to allocate public expenditure most efficiently to reap maximum benefits within the available public wealth. Number 2 is a distribution function. There are large disparities of income and wealth in every country in the world. These income inequalities plague society and increase the crime rate of the country. The distribution function of public finance is to lessen their inequalities as much as possible through redistribution of income and wealth. In public finance, primarily, 3 measures are outlined to achieve this target. A tax transformer scheme, or using progressive taxing, in simpler words, charging higher tax from the rich and giving subsidies to the low income. Progressive taxes can be used to finance public services such as affordable housing, healthcare, etc. A higher tax can be applied to luxury goods or goods that are purchased by the higher income group, for example, higher taxes on luxury cars. Number 3 is stabilization function. Every economy faces periods of boom and depression. It is the most normal and common business cycles that would lead to this scenario. These periods create instability in the economy. Stabilization eliminates or reduces the business fluctuations and its impact on the economy. Policies like deficit or surplus budgeting during the time of boom and depression respectively helps in achieving the required economic stability. The base objective of the economic system is the stability of the economy. It refers to the state wherein the fluctuations in the economy due to political, legal, or monetary policies of the government is very less, and so the inflation rate is quite low. The fiscal policy of the country plays an important role here in maintaining a fair distribution of national income in the country, which leads to economic stability. The subject matter of financial administration is how the budget is prepared, passed and implemented. What matters are considered while preparing the budget, how taxes are collected by various authorities, which departments are responsible for auditing and reporting of public accounts. Economic stabilization. The basic objective of the economic stabilization system is the stability of the economy. It refers to the state wherein the fluctuations in the economy due to political, legal or monetary policies of the government is very less, and so the inflation rate is quite low. The fiscal policy of the country plays an important role here in maintaining a fair distribution of national income in the country, which leads to economic stability. Economic growth. Economic growth is when there is a rise in the production of goods and supply of services in comparison to the previous years. Many experts are of the view that the problem of economic growth lies in developing countries only. Therefore, public finance is considered as one of the main tools with the help of which the country can cope with the problem of economic growth. Public finance studies how the government raises funds, where it spends the funds raised, how the government operating at various levels provides necessary services and facilities to the public, and how the government arranges funds to provide these services. In finer terms, public finance looks after the facts, principles, policies, theories, techniques, rules and problems which determine, direct, influence and regulate the use of financial resources to alternative projects initiated by the government.